Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Big tech earnings continue to roll out with investors eyeing Apple and Amazon. We're going to have full coverage on those reports. And President Trump's August 1st tariff deadline looms. We're catching up on what the most recent deals mean for markets and the economy. There's still half an hour to go here, an hour to go until trading, until the closing bell. And right now, stocks mixed here. If you look at the popular averages, the Dow is down about 110 points. The S&P 500 is basically flat. Your tech-heavy NASDAQ up about 0.3%. Let's welcome in now Jeff McLean, Solidarity Capital CEO. Got tech editor Dan Howley and markets and data editor Jared Blickery joining us throughout the show to break down the headlines. Jared, let's get a check on the broader markets. Also, the NASDAQ does appear to be rallying here with big tech earnings this week, Jared.
You know, we had a little bit of a pop on the open, and we're going to go to our NASDAQ 100 heat map in a minute. Let me just show you what's happening in the Dow real quick. Even the Dow opened in the green, but this is a 4-day look, so this is what's happened this week. But let's just take a look here in the green, and now it has shifted into the red. NASDAQ Composite opened higher off of those Meta and Microsoft earnings, slightly dipped into the red after the 2 p.m. hour, and then just a little bit in the green right now. S&P 500 barely holding on to green. That's a very familiar story. And here's the Russell 2000. That is down more than the others, about 0.2%, having spent most of the day in the red. And let's just take a quick look at the bond market here. We have the 10-year around 4.36%. That is down 2 basis points here. And the 30-year also down a little bit, 3 basis points to 4.88%, well below that 5% mark that was causing some hiccups a few weeks ago. And here's U.S. dollar index. I'm going to put the 10-day view. It is up 6 straight days, 2.17%. That is a big amount for and that is something to deal with for investors with the world's biggest currency and the reserve currency. So here's a look at the sector action. Communication services. Guess what? That is a Meta story, up over 11%. That is up 1.25% here. Industrials and utilities also outperforming. Financials barely in the green. But the big story is healthcare. A lot of pharmaceutical headlines sending some of those stocks south. President Trump writing some letters to some of the executives at those biggest companies. I'm sure we'll be talking about that as well. Real estate down 1.4%. Back to you.
And Dan Howley, let's jump right into what we can expect from giants Apple and Amazon later today.
Yeah, Josh, it's going to be a really interesting story. Let's start off with Amazon first. That company has a lot of pressure on it now that both Microsoft and Google have reported their own earnings, beating on the top and bottom lines for both of them and posting good stories around their AI investments. Google obviously saying that their AI continues to drive Google Cloud Platform revenue or Google Cloud revenue. Microsoft finally revealing Azure revenue for the first time, saying it brought in $75 billion in fiscal 2025. It also helped push the company's market cap past $4 trillion at the open this morning. So clearly Microsoft and Google have done well. They're showing that their AI investments are paying off. Now it's up to Amazon to do that as well. Oh yeah, and also make sure that its retail business isn't getting hammered by tariffs. And then on the Apple side of things, we're basically looking for what's going on with Apple's AI. Can they give us any insights into how it's progressing? Will we hear anything about what Apple plans to do if that deal with Google is forced to be abandoned, where Google pays Apple $20 billion a year to use Google search as the primary search for Siri and the Safari browser? What happens there? That's a huge chunk of money that could come out of services if the judge that's overseeing Google's antitrust case says you got to put the kibosh on this. So iPhone numbers are going to be big, but really I think it's going to come down to basically commentary around those two areas.
And Dan, being the Apple tech reporter veteran that you are, I'm interested when that Apple report hits the wires, Dan, right? What's the metric you make a beeline for? Is it margins? Is it iPhone revenue? Do you want to wait till the call for that September guidance? What's on your radar?
It's definitely the iPhone revenue, right? I mean, look, we could talk about AI until we're blue in the face, and I think that a lot of Wall Street is kind of confused as to how Apple fits into the AI picture. Sure, they need to be in the AI space. They need to probably take a bigger step. But when it comes to, they're a consumer company first and foremost, right? They're not providing services like Microsoft or Google. Google does. I think for most people, they're right now accessing AI through apps, and that isn't necessarily a bad thing for Apple. So it really does still come down to iPhone revenue. Have we seen any growth there? What does it look like? What about China? There's been some inkling that China might be better off this quarter than it was last. So that's the key metric. I mean, it's literally the first thing that my eyes dart to when the earnings come out. And then, services after that. It's its second largest business. As I said, it could be in some trouble if they lose that Google deal.
And Jeff, we want to get you in here as well, get your thoughts on all these big tech reports, Jeff. Not that just the reports, Jeff. I'm also curious to get your take on the reaction to the reports. You got Microsoft up about 4% right now. You got Meta up about 12%, Jeff.
Yeah, it's incredible what Meta has done. Go back a year ago of where Meta was. Everyone was claiming, hey, are they going to fall out of the Mag 7, right? And so they've made a huge move, a huge push into AI and caught the momentum here. And I think, just to piggyback off their tech reporter earlier, is that I think what I'm looking for from Apple in particular is some guidance, one around tariffs in China. Obviously, the trade deal that President Trump is talking to China about is going to be important. But really, what they're doing from an R&D perspective is going to be interesting. I would also love to see some inkling of an interest in M&A. They have the second biggest cash pile of any corporation out there behind Berkshire. Can they finally put it to use? Would be awesome for investors.
All right, from tech to tariffs, another big topic for investors. President Trump's tariff agenda nearing its moment of truth. The August 1st tariff deadline drawing near and set to establish a new baseline rate of 15% on most of the world. Yahoo Finance Washington correspondent Ben Werschkul joining us now with the very latest. Ben.
Yeah, Josh. So the word from the White House is that all systems are go for a wave of new tariffs to be in place tonight at 12:01 a.m. The White House press secretary confirmed to reporters just a bit ago that the president will be signing a combination of executive orders and letters to implement these tariffs, even as she also added that calls are still going back and forth, and more deals could be announced in the hours ahead. So obviously a lot of deals to be filled in over the next few hours, but we do know a lot so far about what the landscape will be in the morning. First is a lot of these deals that have already been announced. That's 15% tariffs on Europe, South Korea, Japan, 19 to 20% tariffs on places like the Philippines and Vietnam, and then higher rates, including an extension of 25% tariffs on Mexico for at least 90 days. The two big unknowns right now at this hour are India and Canada. These are two countries that have been sort of trying to get a deal for a long time. They've been seen as sort of close to a deal, but things have appeared to go sideways, especially in recent days, in addition to Brazil, who's facing 50% tariffs. And then lastly are a group of about 150 plus smaller countries. These are outside of the major trading partners who are expected to get just informed of their rates. The press secretary added that a lot of the letters that have already gone out, there's been about 24 letters so far, those will be the rates. And so those, we may not get additional details there just beyond those previous letters, but a lot more notifications will clearly happen. And the overall message here is that the White House is trying to reestablish a new kind of global minimum tariff of at least 15%. That's the rate we expect in a lot of these notes, to sort of say this is the reality, this is the bottom, and then tariffs will go up from there.
Ben, also, while I have you, what is going on with India, Ben? Are we any closer there? Do we have line of sight there? I did hear Bessent talking to reporters this morning about it, and I got to say, Ben, he sounded frustrated.
Yeah, for sure. We've seen, it's been one of the big surprises. Right before I came on with you, I was reading a story I wrote in February about how India at the time was seen as kind of in the front of the line for a trade deal, and clearly that hasn't happened. We've seen these comments from Bessent, clearly unhappy with this. The bottom line here, I think, is that India has proven, this is a real kind of trade back and forth fight. India has simply sort of not given what the White House wanted. Outside of China, of course, India is probably the country that has pushed back the hardest on Trump's trade demands. India, they came into these talks with high tariffs. India objectively is one of the highest tariffing countries in the world, but they just sort of aren't giving what the White House wants. And that's the frustration I think you're seeing from Bessent and others. I should note that another big part of the problem that Trump's team says is India's consumption of Russian oil. They're very dependent on oil coming from Russia, and that's been a big issue in recent weeks. Exactly how big of a factor that is to be determined, because there's a different volume when the White House talks about that issue in the context of China, who's obviously another big consumer of Russian oil. The bottom line, as mentioned at the top, is that this underlying assumption that India could find its way to a deal has been challenged. We've been sort of 2 weeks away from an India deal for weeks and weeks now. I will say that there's a lot of, you hear when you listen to Indian trade negotiators, they're still confident that a deal is possible and even likely. The timeline you hear from them is in September, so it's still a month away. But in the meantime, they're facing 25% tariffs as they kind of go back and forth, perhaps on final concessions, perhaps just trying to sort of find their way to a deal.
All right, thank you, Ben. Appreciate it. Well, another important indicator of economic health, labor, and on Friday we're going to have a better picture after the July 2020 jobs report is released. Joining us now is Diane Swank. She's U.S. chief economist at KPMG. Globally, that firm has $120 trillion in assets under management. Diane, welcome to the show. Diane, I actually want to start on the Fed because I am just curious to get your reaction there. The decision as expected, Diane, I thought the presser was interesting. To me, Diane, here's where I'm interested to get your take. I listened to Powell. I thought it skewed kind of hawkish, Diane. I mean, I certainly look at that September cut. Doesn't sound like you can bank on that.
No, absolutely not. And I think, you saw the two dissents, which Chris Waller and Mickey Bowman had advertised that they were going to likely dissent, and they did. And Chris Waller's been clear about what his dissent's about. It's about the labor market. He sees very narrow margin for error, which I have empathy for. We've seen the pace of hiring slip below 2019 levels, the pace of quits slip below 2019 levels. As long as layoffs are low, that's fine. But any rise in layoffs, this is an easy kind of situation where the apple cart could tip over, and that's what he's concerned about. On the flip side of it, today's data on the PCE, which we saw implied in yesterday's data, and that was that tariffs are beginning to have an impact on inflation. And in fact, the PCE index of inflation, the goods PCE index of inflation on a year-over-year basis on those big ticket items that are most susceptible to tariffs, appliances, furniture, sporting equipment, tools, all of those things, that went up at their fastest rate on a year-over-year basis today for the month of June since December of 2022. That is something the Federal Reserve is concerned about, and the uneven rollout of tariffs, how they're coming in waves, which we're going to likely see effective tariff rate around 9 to 10% that in June is likely to double with what we see coming on in August and what's still in the pipeline on tariffs, on sector tariffs. That's a big move in tariffs, even from where we're at, and especially from where we were at the start of the year, which is below 3%.
And Diane, to the extent that we see tariff-induced inflation, do you see that as one time, which then eases and subsides, or no, it would be persistent?
That's the key issue for the Fed. And what they're not sure about and what nobody is sure about is whether or not, first of all, it's more than a one-time bump because of the uneven nature. But, it could be a 2 or 3 time bump and then be over. And that would be the ideal situation for the Fed. But the reason they're reticent on cutting rates right now and stimulating the economy is because of the threat that not only could it be longer with the uneven nature of it, but also we've seen contagion, and many firms are saying they're going to raise prices. Now, what's going to be important is what is the gap between what they're going to try to charge consumers and how much consumers push back on that. And that's where the dissent is within the Fed. I think the risk is, though, coming off of an inflation that was yet to be tamed. The idea of price stability is one where none of us think about prices anymore in how we do our spending and how we time our spending in our purchases. Well, clearly, that's not where we are at this moment in time. And you cannot get to full employment for any sustained length of time unless you get to price stability. And what the Fed is concerned about is that this may not be a one and done like you usually see because of the uneven nature of it and because we're so close to the proximity the pandemic-induced inflation, and there's some muscle memory there. Certainly firms have been telling the Fed that they're ready to hike prices, and there's more in the pipeline as we get into August.
Let's talk about the jobs report tomorrow on deck, Diane. What do you expect?
We're looking for north of 100,000. That's lower than it has been, but in line, just a little lower than the 130,000 we've had year to date. And what's important is, and this is a point that Jay Powell made yesterday as well, he said the job market is solid. I think it's a little mushier than solid, but he said it was solid because the unemployment rate has remained low. You only need about 100,000 a month or a little less than that to keep the unemployment rate low. I think we're in a tick from 4.1% up to 4.2%. The consumer confidence surveys have shown that consumers are having a harder time finding a job, and the reason quit rates are low is because you don't get as much of a premium for hopping a job, and there's not as many opportunities out there. And we know from places like Indeed that internships and new job openings for new college grads are not what they've been. They're at multi-year lows right now.
Trump's crackdown, Diane, on illegal immigration, do we know how that is impacting the labor market yet?
So that's a great question. We're all watching that. There has been some signs of it, but we don't like to read too much into the household survey. It's not seasonally adjusted on foreign-born versus native-born workers and how many we've lost since March. There has been quite a few. That said, there is in the employment cost index today, construction is one of the sectors, even though construction is down. It was down in the second quarter. Activity is down. Interest rates are higher. The residential market is not going. Commercial market is not booming for data centers. The construction sector has seen wages accelerate quite sharply. That's one of the most immigrant-sensitive sectors. About 25% of construction nationwide is immigrant workers. And so if they're actually feeling a shortage of workers in the employment cost index, the move up in construction was really quite startling between the first and the second quarter, and that would suggest that there are some pockets of shortages showing up.
Diane, always great to see you and to have you on the show. Thanks for joining us.
Thank you.
We are just getting started here on Market Domination. Coming up, CoreWeave stock soaring. We're going to explain why, and also look at whether its AI expansion is a boom or a bust. Plus, President Trump putting fresh pressure on pharmaceutical companies to lower prices. We're taking a deep dive into what that could mean for investors. And healthcare payments company Waystar reports earnings. We're talking directly with the CEO about that company's performance and future. Those stories and more coming right up. Now time for some of today's trending tickers. We're watching shares of CoreWeave, ARM Holdings, and AbbVie. Starting off with CoreWeave, fresh off a Citigroup upgrade to buy on that one, and a Morgan Stanley target hike. So Jeff, Citi does take this one a buy. They say we come away with a much stronger fundamental view on the demand picture, highlighted by Microsoft. Their target is 160. Next earnings announcements, by the way, August 12th it looks like. Most on the street are actually on the sidelines on this one, but Citi likes it.
Yeah, and I'm not surprised. Ever since they IPO'd, it has had a strong reaction to the market. Markets loved it, gobbled it up.
Right,
Their price is looking fantastic, and based on those projections, look good too. They're the AI story. So if you fundamentally, from a macro perspective, believe the AI story is going to continue to grow in the market, great buy, great opportunity. If you think in the future there's going to be some weakness in the AI story, that valuations will come back down to earth a little bit, then that's where you start scratching your head a little bit on the valuation. But all signs point to right now for CoreWeave, up and to the right.
Citi does highlight some risks. They talk about limited trading history. They talk about what they call high customer concentration, but it is a buy, according to Citi. Next up, check out ARM Holdings, seeing shares there fallen after the company's first quarter earnings that included a revised profit outlook for the current fiscal quarter. So they did offer that lower than expected profit forecast, Jeff, for the current period. They are spending over there on new products. CEO Renee Haas gave an interview to Bloomberg saying basically, okay, spending will impact profit in the short term. His point was it's going to help us over time. He said, we have made a very conscious decision to invest more heavily, he said. We're accelerating investment in R&D. Stock down about 14%.
I know, and I kind of love that it's down based on that, because that's a short-term blip for what they're trying to achieve long-term. And so a bit counterintuitive, but that gets me excited, right, of ARM going down that much, and that's just today, and we'll see what happens.
Hey, that's an opportunity.
Yeah, that's an opportunity to look at it, because they have a really good long-term TAM. This isn't a weakness because they're not hitting sales numbers, they have contract issues. It's, hey, we're going to put more into R&D and grow long-term. I actually love that.
All right, final one. AbbVie stock, that one's fluctuating. Weighed an improved profit outlook with increased pressure from President Trump over drug prices. AbbVie, they did raise their full-year profit forecast. It sounds, Jeff, like that was thanks to sales of new immunology drugs. Yeah. It sounds like a good start to its new Parkinson's treatments too. I do see BMO's Evan Seigerman cited as saying here, AbbVie's commercial engine, he says, continues to shine. We should also mention we had reports say the company's in talks to acquire psychedelics maker Gilgamesh Pharmaceuticals. Stock is up around 20% this year. It's basically flat in today's trade.
Yeah, I mean, they have a good story of, hey, we have some legacy drugs like Humira, tailing off, and these new drugs, thankfully, are coming online at right about the right time for them to keep the revenue consistent. I don't think this is going to be a high flyer by any means, but a good, solid value stock. Yeah, I think AbbVie hits and checks those boxes from where they are today and looking into the future. But I wouldn't expect this in any way to be a high flyer based on these new drugs, but they're going to be able to keep up.
All right, let's stick with this space because President Trump making a flurry of Truth Social posts that includes letters to CEO of big pharma companies about drug prices. For more, let's bring in Yahoo Finance senior health reporter Anjali Kamani.
That's right, Josh. We got word today from the White House that Trump was going to send out these letters to 17 big pharma companies. The letters include an increase in the pressure on these companies to bring their drug prices down, including to follow what President Trump has been trying to push since his first term, which is the most favored nations clause. That means bringing the prices down to the lowest price of developed countries. In the letter, he does put a 60-day deadline and says domestic most favored nation pricing will require these companies to negotiate harder with foreign, quote unquote, freeloading nations. He does include putting the entire portfolio of these drug companies on the MFN pricing for Medicaid, any new drugs for both Medicare and Medicaid, as well as engaging in most favored nation pricing for direct to consumer. We've seen companies like Pfizer and Eli Lilly take on that recently through telehealth, especially for those GLP-1 drugs. And so this is putting pressure on those companies to really put it throughout their portfolio. As you see on your screen, just some of those big pharma companies that have been a part of this. We have seen as well the sort of market cap. I did some little number crunching for you. The market cap of all these companies is $3.3 trillion. So that's who he's fighting with right now, is those big companies. This also comes after Trump passed an executive order in May, which basically gave the companies time to negotiate. That was a 30-day window then. And in a statement today, the White House said that today's letters indicate that the industry proposals have fallen short and Trump will take nothing lower than the most favored nation pricing. So now the new deadline is September 29th, and we'll see what happens then. Many companies that I tried to reach before joining the show either declined to comment or said that they will just be working on, working with the administration.
All right, thank you, Anj. Appreciate it. Well, shares of Waystar, they're rising after the healthcare payments software firm beat on the top and bottom lines in the second quarter. The firm seeing subscription revenue rise 17% from the prior year, also raising its full-year outlook. And joining me now for an exclusive interview is the CEO of Waystar, Matt Hawkins. Matt, it is good to see you on the show. So you reported, Matt, investors like what you had to say here. The stock's up more than 4% in today's trade. Walk us through the results, Matt, what you're seeing in the business, and where are you seeing the strongest client momentum, Matt?
Hey, thanks, Josh. It's great to be with you. We are pleased with the results in the business, and thank you for acknowledging. This is now 5 consecutive quarters of strong double-digit revenue growth, adjusted EBITDA margins above the consensus, and we've updated our outlook for 2025 given the conviction that we have in the business, the strength of our business model, and what we see in the demand environment. We know that our software helps providers get paid faster, accurately and efficiently as they interact with insurance companies and also as they interact with patients to get a fair understanding of how they're going to get paid. And the work that we're doing is taking hold. We're helping to reduce the likelihood that an insurance claim gets denied, and that's really meaningful right now. It's a societal hot point, and it matters to providers and to patients alike.
You know, Matt, I think you guys have been public now for, I think it's a little over a year, Matt. I'm just curious, what's been the big lesson learned in year one?
Big lesson learned for us is to do what you say you're going to do, and we've worked to do that. We've made our commitments. We have a strong financial profile. I think the other lesson learned is there's value in being able to be a public company, to hold ourselves to a standard of conduct that matters to not only investors, but to our clients, and to drive awareness about our story. Our story really resonates with providers and with patients. And we're grateful to be public, and we're really pleased with the progress that we continue to make as a public company.
You know, Matt, kind of a broader question for you. Now, healthcare, you look at this sector, very enthusiastic about leveraging technology, and for good reason, because obviously you're trying to maximize efficiency and productivity. There can be risks there too, though, Matt. You know, you think about the cyber attacks we've seen in the industry, and I'm curious just how as a CEO you sort of weigh that. You know, the attraction of the technology, the move for efficiency and productivity, but you're also trying to avoid the kind of pitfalls that we've seen in the industry as well. How do you balance all that?
Sure, it's very important. You highlight several key themes that matter to provider decision makers as they make technology choices. It's a fact that providers are constantly looking for ways to be more efficient and to serve patients in their communities, but they definitely want cybersecure solutions. They want to work with trusted partners that can help deliver AI. There's an industry problem. In healthcare, there's over $440 billion of administrative waste. And so anytime that a provider can use great market-leading software that deploys the power of AI like Waystar's does, to help them reduce these inefficiencies and help them get paid faster, accurately, and more efficiently than ever before, they win. And we hear that constantly as we interact with these decision makers. And that's creating demand for our solutions, and certainly ways for us to get prioritized in the decision-making process with these providers.
You recently, Matt, acquired Iodine Software. I'm curious if you could walk me through that acquisition, what it's meant for the business, Matt. What was the gap you were trying to fill there?
Yeah, we think this is a highly strategic and complementary solution to what Waystar does today. We're market leaders on what you would call the front end of the interaction experience as providers get to know a patient, who they are. And then on the other side of that, we help process claims at market leading rates and help to drive fast and efficient reimbursement. Where Iodine fits nicely into Waystar's puzzle, so to speak, is they deploy AI in that really important middle part where a patient is seeing a clinician, and the clinician then takes that clinical unstructured information and begins to form a claim that can be submitted accurately and successfully. Iodine uses AI to bring improvement and intelligence to that unstructured clinical information so that it ultimately can become an accurate claim and reduce the likelihood that a claim gets denied. Our ultimate goal here is to create the perfect, undeniable claim. And we know that a lot of reasons that claims end up getting denied in the first place is in that middle part where after a provider has seen a patient, they're trying to recollect or understand what the clinical notes were. Iodine helps them do that with market-leading AI, and it's very complementary to what we will do with Waystar and what we'll do together. The other thing I'd highlight is it's financially accretive from the get-go. We think that it's really just a powerful combination for Waystar.
Final question, Matt. You sometimes will hear from providers about kind of vendor fatigue. You know, they work with so many tech partners that it can feel duplicative. How do you make sure, you know, your company doesn't fall in that camp, that you're seen as truly essential, not just another add-on?
Sure. We're market leaders in the work that we do, and clients really matter to us. Their delight and satisfaction matters to us. We're market leaders in net promoter scores, things that measure client satisfaction. We're market leaders in industry benchmarks that measure leadership in AI and leadership in software. And we have a trusted platform. And so we constantly think about that. It's a fact that provider decision makers are constantly making choices on who they'd like to work with. And they tell us in, for example, a recent Forrester research report that we saw, that they would like to work with a trusted partner versus small little point solution type companies or upstart companies. We're grateful that Waystar is viewed as that, and we don't take it for granted. We like the momentum that we have in the business, and we're executing on our plan to grow and innovate and delight clients along the way.
Matt, great to have you on the show today. Thanks so much for your time. Appreciate it.
Thanks, Josh. Have a great day.
Stay with us. We're exploring two big name stocks with an expert to let us know if it's a good buy to your portfolio or if you'll be saying goodbye to owning it. That and more coming up. Welcome to Goodbye or Goodbye. Our goal here to help cut through that noise to navigate the best moves for your portfolio. I'm here now with Jeff McLean, CEO of the boutique asset management firm Solidarity Capital. Jeff, let's get to some buys and sells here. The first one you like would be Nike. Now, this one is actually basically flat year to date. Most analysts do like it now on the street. We're going to go through the reasons you say it's a buy. The first one, new CEO plugged the leaky ship. What do you mean by that?
Yeah, so last CEO had the worst 3 years in Nike history. Elliott Hill comes in, has been there for 36 years before he was encouraged to leave before, right? Started as an intern, has rebuilt it quietly. You'll notice he's not on the news. He's not giving interviews. He's busy doing the work of stopping the tide of bad wholesale relationships with their biggest distributors, cleaning that up, getting that together, doing some new partnerships, cleaning up product. I think he's done a fantastic job and exactly what investors hope for. Remember, although it's doing okay year to date, it's still 50% off its highs. It has a lot of work to do, and he's starting to do that dirty work to get them going forward.
Second reason you say this is one for your portfolio, focus again on running and new styles.
Yeah, so my joke about this is like the old hair club for men commercials. I'm not just an investor, I'm also a client, right? And so with Nike, they've got to get away from the classics of only having the classics. There's only so many ways that you can innovate on an Air Max from 1990. And so they've got to create new product, new things. They've got to refocus on running because they've lost space there to all the big running shoes, have made huge inroads into running for Nike. They've got to refocus there, and he's starting to do that good job to do that. Again, product guy by background, I have a lot of faith in him being able to nail the product side, but they've got to continue to work there.
Final reason you say Nike is a buy, tariff worries less impactful than feared.
Yeah, from a long-term perspective, the tariffs don't scare me. Short-term, yeah, there's some intermediate issues that they're going to have, whether it's with China in particular in that trade deal that could possibly come up there. But from a long-term perspective, I don't have a lot of concerns around the tariff issues with Nike. They'll figure it out. Good management team. They'll be able to navigate the political realm that is going on right now with tariffs. I have confidence that they can do that.
So you've made your case, Jeff. You made it very convincingly.
Yeah.
Before everybody piles in, though, let's talk about the downside risk to Nike. You say failure to innovate the product.
Yeah, so they have a lot to do. You're starting to see this a little bit. They've rolled out some partnerships with WNBA players as the attention of the sports fan has started to veer towards the WNBA really for the first time in a significant way. Some of their shoes around WNBA players were gone like that. They need to continue to do that, roll out some of their new technologies with shoes with the right type of athlete and endorser, and I think you're going to see good success. If they don't and keep relying on the classics, that's bad news.
All right, so Nike is a buy. Let's check out one you would say you would avoid. That would be Citi. Now, this one has had a nice run this year, Jeff. I would say a lot of the analysts who come on will tell me that they like the name, they like CEO Jane Fraser. You say avoid it. Let's go through the reasons why. One, victim of their own success.
Yeah, they're doing great. There's nothing in here from their business model that's negative. They're at their all-time highs. They're up 37% roughly year to date. I mean, they're just absolutely on a tear. On the flip side of that, they are on a tear. They're at a really high price to earnings ratio compared to where they were when you wanted to first start buying Citi a year or two ago. And so, again, not big issues, but has the story played out? We'd say it has from an investment opportunity. They're at the same PE ratio as JP Morgan. Would you put those right next to each other? I wouldn't.
Second reason you avoid it, you say risk from rate cuts.
Yeah, so all the banks have benefited greatly from the higher interest rates. Obviously, we heard from Chairman Powell yesterday that rate cuts, nothing on the immediate horizon. But from a medium-term perspective, we're going to have some rate cuts. The amount that they're earning from net interest income has got to come down, not just for them, but all the banks. You're going to see that over the next 6 to 9 months as a storyline for all the financial institutions, that this sheer amount of money they're making off interest, it's going to go down.
Third reason you're not buying Citi, weakness with consumer delinquency rates.
Yeah, so we're starting to see some weakness with consumers generally. We saw some data around, right, auto loans, right, delinquencies and payments, late payments, unable to pay. You're seeing some issues with credit cards. At some point, as the consumer weakens, because the Fed continues to hold the reins of tightness, that's going to unfortunately be a cascading effect. We don't see that as a huge, gigantic issue, but consumer weakness is not great for the banks.
Final question on Citi. Talk about upside risk to this one, Jeff. How could you be wrong?
Yeah, one is they have a lot of room to grow in the wealth management space in particular. We'll see if they can execute on that. That's a tough ask for a lot of these banks that don't have a strong bench there, like a JP Morgan or a Goldman Sachs. Can Citi grow to that extent? Also, what kind of M&A opportunities could they look for in some of their business sectors where they don't have exposure, like some of their other bigger bank competitors who have exposure to those spaces? So growth, they could use their M&A, but also the wealth business, which is consistent revenue. Investors really like it. If they can actually execute on that, I could 100% be wrong.
All right, there you have it. Jeff says, buy Nike, avoid Citi. Thank you, Jeff, and thank you all for watching. Goodbye or goodbye. More market domination. That's right on the other side. In the beginning, it was unimaginable to think of a world without Steve Jobs at the helm of Apple. Although Tim Cook isn't going anywhere as of now, we're taking a look at what the future of the tech giant's leadership could be with tech editor Dan Halley, who has more.
Good morning. Welcome to Apple Park.
Apple may not be the powerhouse it's become without CEO Tim Cook. He served in the position since 2011 and has overseen the rollout of some of Apple's biggest products, including the iPhone X, the launch of its TV streaming platform, Apple TV Plus, and ushered in Apple's push into financial products with the Apple Card. Now the company faces pressure from Wall Street over its slow move into AI and the search for its next big product post-iPhone. This has led analysts at Lightshed Partners to question whether it's time for Cook to step aside and make way for a product-focused CEO. Right now, there's no indication Cook is in danger of losing his job, but Cook is 64 years old, and despite his successes, he won't lead the company forever.
Cook continues to be the Hall of Fame CEO. He will lead Apple, I believe, at least the next 5 years.
It wasn't that long ago that you could give Tim Cook credit as having created more value as a CEO than any other CEO in history. And we're talking about like 2 to 3 years ago. It's not that long ago.
I think there's a sense that, maybe some fresh blood in terms of the thinking within executive management would make some sense.
That leaves the question of who will take up the reins of one of the most important technology companies in the world. Jeff Williams, Apple's previous COO, was once seen as Cook's potential successor, but he's retiring from the company later this year. Still, there's no shortage of top candidates at Apple who could take over for Cook. Craig Federighi, the company's senior vice president of software engineering, leads development of its Mac and iOS products. He also makes regular appearances at Apple's Worldwide Developers Conference, making him one of the most visible candidates in Apple's lineup. John Ternus is also a solid option as Apple's future CEO. He's been with the company since 2001 and has overseen the development of a number of products, including the iPad and AirPods. Perhaps more importantly, he's also been instrumental in Apple's move away from using Intel chips in its Macs to its own processors. Greg Joswiak, Apple's senior vice president of worldwide marketing, has worked at Apple since the late 1980s, giving him a wealth of knowledge about the company and its various products and services. Eddie Q, Apple's senior vice president of services, currently leads the company's most important business segment outside of the iPhone. He's been with Apple since 1989 and brings the institutional knowledge necessary to navigate such a massive company. And then there's Deirdre O'Brien, Apple's senior vice president of people and retail. A 30-plus-year Apple veteran, O'Brien brings along the experience and understanding of Apple's customer base that the company needs to ensure it's meeting user expectations. Cook's still on top for the foreseeable future, but it remains to be seen what Apple's leadership could look like down the road.
Software stocks in focus as IT budgets shrink and a flurry of trade deals upend the macroeconomic landscape. We're navigating how to play the software sector with the Yahoo Finance playbook. And joining me now is Steve Koenig, head of U.S. technology research at Macquarie. Steve, great to see you as always. That August 1st trade deadline, it is here, Steve. And, you think trade and tariffs and the uncertainty that has created. Have you seen any sort of downstream effects of that in the software sector, Steve, in terms of size of deals or length of time to get deals done?
Hi, Josh. Yeah, great. Thanks for having me on the program. We do think that there's more uncertainty that enterprise and SMB customers are facing. And in some cases, it's resulting in longer sales cycles. That's happening. But that is accompanied by a real push by companies to figure out what they need to do with AI, and whether that's using the LLM internally, developing their own retrieval augmented generation use cases, or using the agentic AI functionality being pushed on them by the SaaS vendors. And so there are areas of investment that are happening, and there's some urgency on the part of companies to figure out what they're going to do here. So, there's both headwinds and tailwinds in the current environment. I think in Q1, we had continued good momentum, kind of a carryover from Q4. I think this quarter, this calendar Q2, the June and July quarters, we're likely to see more separation among companies, with the companies that are better positioned as priority investments doing better, and then companies that are maybe more legacy or aren't, whose products are not as much of a priority, not getting as much attention from an investment point of view.
Steve, the AI trade and trend looks intact here just based on the earnings reports that have been coming in. I'm curious, in your coverage universe, you look at those software names, are there certain names, Steve, that you would say more leveraged to that trend than others?
Yeah. Well, we like three names in particular, especially coming up into these June, July quarter prints. All outperform rated: Autodesk, HubSpot, and Atlassian. And all of those companies have some very interesting AI opportunities. I would say HubSpot and Atlassian, the ticker there is TEAM, T-E-A-M. They're both furthest along in applying agentic AI to a variety of use cases. In HubSpot's case, it has a lot to do with marketing, content creation, and customer service, these use cases in the customer relationship management space. And for Atlassian, their agentic AI strategy has a lot to do with accelerating the software development lifecycle and enhancing collaboration across business teams and across the entire company departments, including CRM and HR.
So Autodesk, HubSpot, Atlassian, all buys. If I were to push you, Steve, and say, which is your favorite child, would you say you have a strong buy on one of them?
We like all three of these, and we always like to, especially going into the prints, have several picks that we think, some are probably going to do well. If we can hit 2 out of 3, we're pretty happy. So we would advocate, going for all of these companies and accumulating now and averaging in. I think Autodesk is especially interesting because the AI opportunity they have, it's still formative. And it's probably underappreciated by investors what they're going to be able to do. What they do, and product-wise, they facilitate essential design work across architecture, engineering, construction, manufacturing, media, and entertainment. And their design tools are the standard, basically, in all of those industries. They have an opportunity to apply generative AI to enable product designers and architects and engineers to use text prompts and to start with an idea for what they want to build or the product they want to create, and then use generative AI to actually create the design. And Autodesk is still working to make this happening, putting the infrastructure in place. They haven't talked a lot about it on the outside, but I think over the coming quarters, we're going to be hearing a lot more about their AI strategy.
All right, Steve, so we got your buys. Let's talk about names you're not as excited about. Salesforce, Steve, you're neutral. You're on the sidelines. Why the lack of excitement there for Mark Benioff's company?
Yeah, well, I mean, they deserve a lot of respect. 20 plus years having pioneered the SaaS space, and creating the SaaS-based CRM market, if you will. The last several years, though, they've been under a lot of pressure ever since the kind of the pandemic era spending started to. That burst of spending started to wind down. They've had headwinds when it comes to customers that are renewing and customers wanting to spend a lot more money on Salesforce. And you've seen that in terms of their subscription revenue, the sequential additions to that sequential revenue have been actually falling year on year for the last 10 quarters or so. we think they are coming up probably to an inflection in that as we lap some of these comparisons from the kind of the post-pandemic spending slowdown. So I think they can start to do better from a revenue production perspective. But I do think there's still some over-optimism about their AI strategy, which is a solid strategy, but it's going to take time, especially for the bigger customers to get their data in order, and for Salesforce to get its revenue model associated with its AI products, and also its sales commission model, a lot of operational things to take care of. Lastly, I don't think it was a real positive sign that they have basically cut off third-party Gen AI tools, large language models from accessing Slack data, even when customers that are using their Slack product want to access that data for the use in training or fine-tuning models or creating new use cases. And I think that looks to us very much like a defensive move by the company. And maybe it's a smart thing in the short term to keep companies like OpenAI and Glean out of the customer data that they host for their customers. But long term, I think it signals sort of a balkanization, kind of a siloed approach to making SaaS work, and that's not what SaaS has been about for many, many years. So I don't know if that strategy is really going to work out long term that well for them.
Steve, I always appreciate your time and those picks. Thank you, sir.
Thank you, Josh.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action around Amazon and Apple, quarterly earnings, plus the closing bell up next. Stay tuned for Market Domination Overtime.